What's going on, guys? Brian's here. Today is Tuesday, December 14th, 2021, and the market is closed. Jumping right into it, what we're looking at is a clean chart. Today, we're going to be focusing mostly on price action and, more importantly, why does the break and retest trade work so well? So what we have right here is what would have been considered resistance. As we can see, the market broke out and then it pulled back, and this level that it pulled back to is what we call the retest, or this pullback is also referred to as the retracement before the market ultimately went higher. Now, why does this work so well and what's the psychology behind it? If you're anything like me, when you first learn technical analysis or you first learn to trade altogether, one of the building blocks of trading that we learn about is called resistance and support. And down here, this support would also be referred to as a demand zone, and this could also be referred to as a supply zone. If we think about the psychology behind the participants of the market right here, we see this level, this rejection that happened on this wick of this candle right here, that to a bear can be considered some sort of confirmation that there are other sellers in this area. Now, why would there be sellers in this area? If we take a second and we rewind back, we can see this consolidation period right here. During this consolidation, while the market was choppy, we can see it ultimately ended up selling off. This was the first retracement back to this level. In this area, all the participants that were buyers here, let's assume that this is an all-time high, so ATH for whatever this is. If you're curious, this is actually the S&P 500 futures, so the ES is what it's most commonly referred to, and these are 1-hour candles, but the candlesticks, the time frame, none of that really matters. It's entirely about the psychology behind this, because what I'm showing you guys in this video today can be applied to any time frame, any ticker, any market, pretty much anything that's dealing with commerce that you can plot on a graph. As we reference this first set of traders right here, we just established that this is all-time highs for whatever underlying it is that we're studying. Anyone buying at this level would be buying for the highest price this commodity or asset has ever been. So we're talking about buying something, let's just say the price of this asset is going for $100, right? And you decide to be an investor, and it's your first time investing, and you decide to buy 10 of this. That means you are investing $1,000 of your money into this stock. Now, a couple days later, the stock loses value and you're immediately down on your money. So your $1,000 might be worth, if you started with 1K, let's just say it's now worth $800. That's obviously not going to make you feel pretty good. And what do you think you're more than likely to do at the first time price comes back to this level? You can pause this video and realistically ask yourself that. You bought something for $1,000 and a couple days later it's going for $800, and then a couple days later it's going for $1,000 again. Any human is more than likely going to look to just sell, because at this point you're getting your $1,000 back, and you're just more than likely going to be grateful that you did not lose any money. That right there is the psychology behind why does a supply zone work. If this is considered supply, how do we know it's supplies? Because there was a lot of participants here, the market was pretty balanced, but then it ultimately sold off. So that meant that there was not a lot of demand for this product at this price. So with this supply being created here, as price returned to it, there was still a lot of supply up here, and until that supply is exhausted or demand exceeds supply, price will not go higher. So that will be a little bit on supply and demand. But now let's think about what's also happening for the other participants in this market. There are sellers here that were once buyers. So anyone that bought here are now selling. But what about the other participants? As we know, there are bulls and bears in the market, and bears are people that short sell. If you're shorting, that means you're borrowing an asset and then you're selling it and you're looking to buy it back lower. So if we use an example, usually whenever I'm teaching new traders this, I like to tell them, imagine if the price of the iPhone is trading for $1,000, right? So we have it on the open market and it's trading for $1,000, and you happen to be a really good friend of mine and I know that you own an iPhone. Let's just say I call you and I say, hey, can I borrow your iPhone? And you're like, sure, because you're not using it. If you give me the iPhone, the first thing I'm going to look to do is sell it to the market. If I sell it to the market, I'm going to collect $1,000. That means I now have $1,000 cash in my pocket, but I no longer have an iPhone. Now, assuming a couple days later, the price of the iPhone is going for $500 and I decide to buy it back from the market. Initially, I sold it for $1,000. That means I had $1,000 cash and now it's going for $500. The difference between these two would mean that I'm buying it back for $500. That means I keep the difference, which would be $500. So I now have $500 in my pocket, and I also have an iPhone. Now, a couple days later, I decide to give you back the iPhone. So you, as my friend, you had your iPhone, you lend it out to me, I sold it to the market, but then I bought it back. You didn't necessarily know what I did with the iPhone. All you knew is that you can trust me enough to return the iPhone for you. What I ended up making from that transaction is $500. And that's what bears are doing whenever they're short selling. So if we look at this right here, there are bears that are aware that this is considered a supply zone. So as price comes back up to it, they're more than likely going to look to short the market. As price comes back down lower, the first thing they're going to look to do is buy it back. So this is the equivalent of selling an iPhone for $1,000 and then buying it back for $500 down here, making a profit. Now, if you're a bear and that worked out for you here, what do you think is the first thing you're likely to do as price comes back to this level? You're probably going to short it again. Now, if you short it and it comes back down here, you're going to look to buy it because you're aware that there's a lot of demand for this product down here. So pretty much, let's just say it's $500. There's a lot of demand for the iPhone at $500, and there's a lot of supply for it at $1,000. In other words, it's too expensive up here, and this is a good deal. Now, what happens when the market starts pushing up, and we can see we come back to this same zone? Now we have short sellers that are going to come right here and try to do the same thing. They're going to look to short. Now, what happens if you were to sell the iPhone to the market and you're a short seller and you sold it for $1,000, and then a couple days later it's going for $1.5 thousand? You're now down $500, and that's not a good feeling to a short. And this is what's happening as the market squeezes up like this. Now, when the market comes back to this level, what do you think a bear or a short seller is more than likely to do? This is their opportunity to buy back what they shorted, taking no loss. So if we rewind for a second, we established that if you were a buyer here and then price dropped and it came back to here, the first thing you did was that you decided to close your position, and you're just happy that you took no loss because you bought it for $1,000 and you were able to sell it for $1,000, so you lost no money. Now we reversed that script and we talked about the bears. If you're a bear and you sold something here and then the price went higher, you need to buy it back, but you don't want to buy it back higher. You want to buy it back when it's lower, but in this case, the price did not go lower, it actually went higher. So the first thing you do as it comes back is you now turn into a buyer. This type of buying can be considered false buying because it's not a new buyer in the market, or it's not a new investor. It's just a bear from back here that's actually just looking to close a position. And that's why we end up getting this pattern of a breakout, a retracement, some sort of false buying, a little bit of a retest, another retest before we end up pushing higher. This is when the new wave of buyers coming in, because this area is an opportunity for all of the shorts that were shorting here and were shorting here to actually get out, suffering no loss. So if we draw out the supply and demand zone on the chart like before, here would be our previous supply turning into future demand over here. And you guys understand how that works. Hopefully this is a good enough example to explain it to you guys. In the future, I'll probably make some sort of animated video to really further illustrate this. But think about the psychology of the other person on the trade. This is why previous resistance becomes future support, or why previous supply zones become future demand zones. If we take a look at another example very quickly, let's wonder, why did the market decide to sell off right here? If we draw out the zone from back here, we can see the market was bouncing at this level we can see that the market decided to bounce here, it bounced here, it bounced here, it bounced here, it bounced here. So this would be considered demand. So everybody that thought this level would hold, that started buying here, ended up being wrong, and price sliced right through this demand zone. This right here was the first retracement to this zone. So everybody that was buying here, this is their opportunity to get out for a break even without suffering a larger loss. Now, if we jump to today's price action, this is the SPY right here. As mentioned in the beginning of this video, it's a Tuesday, so you can come back and So if you're watching this video in the future, you can come back and take a look at what price action looked like. These levels that you see on the chart right here are from the quant trading app algorithm. Full disclosure, I am the lead developer on the algorithm, so these levels are plotted on my chart automatically. There's nothing here that you see on my chart that was manually drawn in. But what we have here is what was presumed to be what's referred to as the buy zone for the week on the S&P 500. And as you can see, we ended up gapping down below it. Now, this is terrible this early in the week. This usually indicates that the market would actually sell off a little bit further, but it's not going to go there in one straight shot. If we turn on the pre-market information, let's take a look at what this looked like. We can see overnight, without looking at the futures chart, you can imagine already what the futures looked like. We ended up selling off, put in a little bit of this consolidation period before ultimately slicing back through it, and then we retraced to this level. So all the algorithms that were programmed to buy the S&P 500 at this level were holding during pre-market, but then for whatever reason, no one knows half the time when the market is making impulsive moves like this, we just slice right through the zone, we come back up to it. All the algos that were programmed to buy pre-market this is now their opportunity to get out for a break even. And these algorithms are programmed by humans. Over 70% of the trading volume that occurs in the stock market is not a person like you and I that's a retail trader that's at home pressing buttons. It's programmed by someone to execute orders following very specific commands. In other words, the S&P 500 algos were programmed to buy at 465 this week. It started buying from pre-market. It broke down. The algo would then know to sell if it comes back up to this level because it has broken past the level in which it should not. And this retracement right here is what we can anticipate before the market opens. So to conclude, I just opened up the quant trading app Discord. This is the Discord in which you can contact me to ask more information. There is a premium description and all the details are on the quant trading app website. So as we look right here at 9 a.m., I had already posted this picture anticipating what the market would do. I was expecting us to bounce at this VPOC. You can check out some of my previous videos in which I talk about the points of control as well as virgin points of control and the volume profile. But the market gapping down like this into a VPOC was pretty much a gift to buy. So the expectation was for the market to retrace to this level because it was not supposed to go past it. Once we retrace to this level, the game plan right here was if we can't get back over it, there should be a short setup there. We want to see an inverted hammer or something of that kind, so a doji or something like that on a 5-minute time frame. Stop will be whatever that candle forms, and we'll also want to see volume. If you're a scalper, you can look to scalp this up to the 460, we'll call it 465 level. This right here is the 465 level. So if we just jump over to Thinkorswim, we can see 465. So I was talking about scalping in at the open up to this level, but then looking for a short setup if we see some sort of wick rejections. Now we didn't get an inverted hammer, so it was not very clean, but we did get a few wick rejections, and this right here is confirmation that sellers are in control. So as we can see, we broke down, and this was the first retracement also to the zone before also getting a harsh sell-off. Jumping back to the Discord, I actually ended up taking the trade long at the open. So let's just scroll up and you guys can see right here, I was scaling in pre-market to a couple contracts, and then my target was pretty much the same level. And as we can see, it played out to the T. Market came up to here, and this is where I was just letting the traders know that I'm flat the futures and then look for the short trade. At the same time, there was confluence with the VIX, and then ultimately there was confluence with the NASDAQ, that the NASDAQ was also hitting the quant trading app resistance level for the day, and then we ended up breaking down. I mentioned just like any traditional support and resistance levels, these zones can break, but if it broke and it retested and it held, that's what it would have taken for the market to become bullish today. We would have needed strength from the tech sector, and we did not get that. So if the market is really going to run today, QQQ will need to clear and hold the intraday zone, which it did not. So a little bit later, it was just re-emphasizing this is what we wanted to be looking for shorts here, and then we can see this is how it played out. So you can start glancing for tickers. Here's the NASDAQ. There was wicks on Shopify. There was wicks on Apple. All of these tickers also retraced to key levels from the algo, and any one of them could have been a decent short. And then lastly, after missing this move, and lastly, if you miss the initial move on the SPY, you can always wait for the retracement. So this is the 50% retracement, and the SPY and the QQQ ultimately selling all the way off to the bottom. So if I just turn everything off on the chart, turn the studies, turn the overnight session off, and let's take a look. And this is a good little tip for you guys. It's the type of trader that I am. I look for the retracements. I'm not a momentum-based trader. Here's the 50% retracement, and the market sold right off to this level. When you can identify this type of stuff before the market opens, it ends up being a really simple trading day, and you end up not getting too psyched out. And guess what? If this did not work, if you took this short here and you got stopped out over here, don't worry about it. The next time it'll work. As long as you can honor your stop losses, your rewards will end up being a lot larger than what you risk. If you have any questions, guys, leave them in the description down below. I still have to catch up to a few of the other questions from some of the previous videos. I've been extremely busy as I've been improving the quant trading app algorithm, and I'm gearing up for the new year to release some huge alerts features in the Discord that will be automatic from the algo. It'll actually be scanning the options chain and sending out trade ideas in confluence with whenever some of these tickers hit the key levels. So thanks for watching. Hit the subscribe button if you're new to the channel, and don't forget to share and like the video. Catch you in the next one.